I've got a perler of a question for you. Are you ever confused by the language that your accountant uses with you? Profit and loss and ratios and gross profit and net profit and expenses, all that sort of stuff. Well, today, I'm going to give you the rundown of what a profit and loss actually means, the important parts to note, and what they all mean, all this stuff, what it actually means. Okay, so today is all about the profit and loss statement. Oh, it's a bit fuzzy. It'll come into focus. Good, stay like that, please. Right, so the profit and loss. A couple of principles to understand first, right? So the first principle is it measures how much comes in and goes out over a period of time. Okay, so all the stuff that comes in, that's good. All the stuff that goes out, not quite as good. And it gives you the leftover part. Make sense? Okay, so it just measures over a period of time what comes into your business and what goes out. That's the basic principle of a profit and loss. Okay, now there are lots and lots and lots of terms that are used for a P&L, and we'll take you through a couple of those. But that's the first thing to understand, is that it's a measure of a period of time. So you will see, I'll start here with the good stuff. Now, depending on your accounting program, depending on your accountant, there may be different terms and different ways that things that we actually call these things. Okay, but the basic principles are this, right? So you've got your income. Okay, the first part of that, obviously, is your sales. So this is obviously the sales from your venue from week to week, day to day, all that sort of thing, opened up over, calculated over that period of time. So your sales, okay? So you've got your sales, and that could just be from your normal, and you might break them into categories. So you might sit there and go, your cafe and delivery. Now I'll show you these sort of things just so you can understand where your income is actually coming from. So once we've got sales, then we start taking off what's called cost of goods sold. Now this is where it's really critically important to get it set up correctly in the first place. Okay? Now, COGS, or cost of goods sold, normally consist of two things. So normally, food and beverages. So that's normally one. And then the other one is the wage cost, okay? The wage cost to actually produce that and deliver that. So not the management stuff necessarily, but wages. And normally I call these productive wages, right? Some managers don't like that term, but it's true. So it's productive wages. So those are the two things that go into the cost of goods sold. So you've got sales less your cost of goods sold. That leaves you with something called, so that sales minus cost of goods sold equals your gross profit. Make sense? By the way, these two things here are called, there's a special name for that, they're called your prime cost. And it's a figure that you should be looking at every single week in your business, right? Every single week you need to look at your prime cost, because every single week it will go up and down to do with food costs and wages and how much time you're putting in for wages to actually produce that food. So you need to understand your prime cost, which is expressed, okay, as a percentage. So typically it could be between sort of 55 and 65%. Any more than that and you're really getting into big trouble. So you want your prime cost to be about 55, 60%. That leaves your gross profit. Now, the way that they typically, now not every software program does that, is there's a line above that and one line below that, and that's your gross profit, okay? So once we've got your gross profit, so I've got gross profit. I'm trying to make this straight for you. Bear with me. Then we take out your expenses. Less your expenses. Yeah, you'll understand that. This is rent, power, phone, gas, etc., etc. All those things. Now, it also includes your management wages, okay? Management costs. So if you have got managers who spend their time, some of their time, not productively working on the floor or doing that sort of thing, then the management time, so the management costs associated with there, will definitely go into your expense column. Now, the purpose of this is to delineate between productive time making and selling food and management time, which is the organization of the business. Okay? So we want to delineate their time. So what you might find is for a few managers, you split their wages into productive, because the time they're spending on the floor doing the do, and then management, the time they're off the floor thinking the think. Okay? Doing the do, thinking the think. Does that make sense? Okay. So you've got all these expenses that come down here. And then you come up with a thing called your net profit. So you take off all these expenses and you've got your net profit. Now, in some software, that sort of thing, it's 2 lines at the bottom, 1 line at the top. Yeah, but it depends. Now, they might say a whole bunch of other words, and this is where accountants love to confuse us, because what they use in net profit, that's the basic concept, is net profit, but they can use lots of other words. They can use EBIT. Hands up who's seen EBIT. Hands up who understands what EBIT actually means. No, me neither. I never used to, but I do. So EBIT is earnings before interest and tax. Interest and tax. Make sense? Now you've also got something called EBITDA. The DA part stands for depreciation and this is a perler, and accountants love to use this, a thing called amortization. Amortization. This is where accountants start earning their money and start saying, ooh, it's a dark art. Depreciation and amortization. Now, amortization is the apportionment of costs for something over a period of time. Depreciation is the reduction in value of the assets of the business over a given period of time. So, for example, you buy an oven and it costs you 10 grand. A year later, it's not worth 10, it's only worth 7,000. So your depreciation for that year is $3,000. And there are schedules as to how these things should actually get depreciated. But that's the basic thing. Now, there's another thing to be thinking of. And so you've heard of EBIT. We know what EBITDA is. But there's another one that you can use. It's EBITDA P. And the P part is the fun part, because that's payments to you. So sometimes when you're looking at a statement of accounts and that sort of thing, we want to find out how much money did the owners actually take out. Okay, so one of the ways that we look at that is EBITDA P. So we look at the earnings before interest and tax, depreciation and amortization, and payments to the principal parties. So if I'm the owner of the business, all payments made to me. Does that make sense? Because I can make it. I might be paying myself above the odds for my day job. So maybe I'm the head chef, and I might pay myself, rather than paying a normal head chef, maybe I'm paying myself a little bit of a premium above that. The premium part is the additional payments to me because I'm the principal of the business. Okay, does that make sense? So we've got that, and most people think that a P&L stops there. And it kind of does, but it kind of doesn't. So let's just say you've got EBIT, earnings before interest and tax, and then you've got to pay some tax. So you've got to pay some tax. You've got to pay some interest, which you do beforehand. Okay, so that's like finance payments, which is just earnings. So EBIT, EBIT earnings before interest and tax is just E for earnings. Okay, does that make sense? Okay, so we've got earnings. Earnings available for distribution. Excuse my you. So earnings available for distribution is the money that you could, if you're the business owner, choose to take home for yourself, or you might choose to leave it in the business. Yay! New car. Woohoo! Love that part. Or you might choose to reinvest it. And reinvest in the business. But it's earnings available for distribution. So you've got to pay tax, you've got to pay interest. You can account for depreciation, amortization. You can make payments to yourself. And then once you've got earnings available for distribution, you can actually take some money yourself. Yay, well played you. Or reinvest it in the business. Now, I would love to be able to give you guidance on what you should do with your money, but that's your business, what you do with your money. My job is to help you make lots of it so you can decide new car or new oven. So that's a lot about the profit and loss. That's one of two financial statements that you'll be getting after the end of the financial year. So hopefully this has given you some sort of understanding about what to actually look for. So the key ratios that I want you to have a look at in the business, right? And you'll be able to work this out from your P&L. The key ratios. So you've got your prime cost. We've already talked about that. And you want to keep that lower than 60%. Okay, you definitely want to keep your prime cost lower than 60%. You want to keep your wage cost by itself. So the two parts that go up to that, you've got wages and you've got food. Okay, now each of those can add up. Now, depending on the business model that you run, whether it's takeaways or fine dining or whatever, those ratios will actually change. So you might be spending a lot more time on wages because you buy food that needs to be processed from its raw product, or maybe you buy it 9/10 finished and you just got to serve it, so there's less wages involved. So have a look at how that prime cost is made up. That's the first thing to have a look at, okay? The next thing to have a look at, okay, is your income per hour worked. So this helps you understand exactly what the productive elements of your business are generating for every hour that they actually work. So income per hour worked, figure out how many hours are actually worked and look at how much money is actually taken for the hours that those people work. Now, there's actually 5 ratios to have a look at. The prime cost is obviously, that's the key one because that sets you up for a really, really good understanding about the inputs into the productive costs of the business. Okay, income per hour worked is really critical. And the other thing I look at is profit per hour worked. Does that make sense? Now, from this, by the way, you should be able to, working with your accountant, figure out another key number. And one of your key numbers is this. This is probably the key number of the entire business. This is your break even. And normally you've got to do this retrospectively because you'll have weeks that are really good and weeks that are really low. And some weeks potentially you might lose money, and some weeks you'll actually understand that you can make money. So you need to know what your break-even point is with a dollar figure. So on average, I start making money after I've taken in X amount of money. Because as we know, let's go back right to the start. We've got some money coming in, that's our sales. We're going to take off some costs, and then we're left with gross profit. Then we've got to look at our expenses, our rent, power, phone, and all those other sort of things, advertising, marketing, all that sort of stuff. And then we're left with a net profit. And then we take away some things like depreciation, amortization, all that sort of thing. But we need a sales figure every single week that we aim for, okay? So I've got clients who do their break-even point normally on a Wednesday afternoon. So they've made everything after Wednesday afternoon, they're actually making money on. And they run a Monday to Sunday week. And every Wednesday afternoon, they ring the bell and say, right, we're actually making money. They work 2 full days, or 3 full days really, paying all the bills of the business. They get to their break-even point. And at that point, they know that they're actually starting to make some money. And the interesting thing is when you look at the ratio between fixed and variable costs in the business, but please discuss that with your accountant or with your business coach. But that's really important to know as well. So there you go. That's the profit and loss. You'll be getting this information through from your accountant real soon. If you've got any questions, feel free to give me a bell. matt@thecafedoctor.com. Find us on Facey. We'll put out other videos to do with your balance sheet and that sort of thing. So hopefully that's made your profit and loss not such a jargon-filled, very confusing conversation with your accountant. I know what accountants can be like because I work with a whole heap of them. So hopefully that's put it into English that you can actually use and apply. All right, if you need to get hold of me, that's where you find me. Until I talk to you next time, take it easy, best of luck, be kind to each other.